That's the question. How are they going to fare? How they can continue to spend? I don't think they can. And we've been concerned, and we say all the time, never underestimate their want, but should they be spending in this environment? So where does it come back? The good news for today, in terms of broader market quickly, the reversal in bond yields were interesting. And we talked about it last night with Andy Constant. He thought maybe another 10 or 15 handles up. You got 8 handles up in the 10-year. We reversed, closed lower on the day. Good sign. I think that's why the market reversed. We'll see how long that lasts. But in terms of the consumer, I don't think it augurs particularly well. The XRT, which is not a great ETF in the way it's structured, some of the stocks, but that's the one everybody watches. I got to tell you something. Closed around 60. 57 or so is your line in the sand. We get through that, and you're going to have a world of hurt, I think.
So just something back on this home thing. If you are a Blackstone and you own hundreds of thousands of homes. Right. Wouldn't this be an interesting time to start selling and put that money elsewhere? It looked not so great for them not that long ago.
Right.
I'm surprised that we haven't seen more supply come on the market.
Well,
go ahead.
Yeah, the last time we had this type of a noticeable bond yield spike is when we were having the conversation about some of the biggest REITs that have been family office, consumer advisory, wealth managers. It's been a haven for collecting yield, and it's been a great place to be. And for Blackstone, who I continue to think are at least some of the smartest guys in the room. I mean, it's been a huge product. But I get back to the market that we have. We've had such a big move in rates. I still actually think equities have behaved okay, given that. And I think if you look at where sentiment has gotten over the last couple weeks, whether you're measuring, Feed and Greer, whether you're measuring AAII, whether you're measuring the name index, which is active money managers, people are bared up, and they're bared up going into the fourth quarter, which, kind of makes me feel decent about things. I don't think we're going to go a lot higher. I do think that the government shutdown has something to do with what the bond market is doing here, because people are then doing the math on all the fiscal dynamics that aren't really going to get better. But, Moody's and some of the ratings agencies have made it pretty clear that they're actually following some of these shenanigans.
It's interesting when you think about just the price action, this reversal that we had over the last couple of days or so, and, how much we are off of the lows, and you look at just the structure of the chart of the S&P 500, it really does feel like a rip into month end, quarter end. It's been a really crappy month. You just look at the numbers here. I think the S&P at its lows was down maybe 6% or so. The Nasdaq down 7%. When you look at a lot of the sectors, though, we were talking about Homebuilders. XHB was down about 10%. The staples were down about 10%. The industrials were down about 10%. So there was like a correction in the market. You know what I mean? And the broad market felt kind of orderly. And then if you want to bring it back to, let's say, Homebuilders, because this is the one that we think is so rate sensitive. We were talking about Williams-Sonoma the other day, breaking out to new 52-week highs. And on the flip side of that, you have the Restoration Hardware that looks like it's going to die. So there's a lot of cross currents here. And then the Home Depot, which, below its 200-day moving average, has really been range bound this whole year, given all these dynamics. So I think it's not such an easy trade. To your point about Blackstone, I think if they put a lot of inventory on the market, I think it does what you asked Diana. I think it puts a lot of pressure on prices, because I just don't think there's a lot of folks who
first of all, Diana Olick's great at what she does, and she's been doing it forever. So I don't want to argue. I wouldn't argue with her. I would just say, theoretically, if affordability really is what housing prices, in other words, you could buy 2 times as much house if rates were 1/2 of where they are today. And that's, to me, just the math around what's going to happen with housing prices. I realize that supply-demand dynamics are a very macro important determinant of pricing. But I also think that there are places where we've had a major run-up in prices, and the people that were buying those were second homes. Those were places that were regional. I think there is going to be pain in some of those markets. And then we still have this exodus out of urban centers. People say this about COVID all the time. It only accelerated trends that were in the works before COVID. I think you're seeing this in urban centers, too.